So my name's Ryan Pape from CBRE Accelerate, and we're going to be talking about family offices and funds. As we all know, family offices, whether they be multi-family offices, which is more prevalent in Kenya, or single-family offices, and funds, be it insurance, pension, private equity funds, they own significant amounts of real estate in East Africa. And today's panel of experienced, I'll call them financial gurus, aims to get under the skin to understand how these large portfolio holders structure their investments, how they should structure them, and versus how they currently structure them, what their outlook is for the region, the horizon that they generally look at in terms of the investments that they make, and what sort of liquidity events are available in terms of exits. So it's quite a broad subject, and we'll try and contain it because it's, as I say, it's very, very broad. But I think we'll kick off with Winnie. Winnie's an estate planner for ICEA Lion. And my question, Winnie, just to start things off, is how is legacy managed locally? What's the current situation in East Africa?
All right, thanks, Ryan. Hi, everyone. And let me just start off by adding simply, legacy is exactly what you have in mind, and I'll add to the things maybe you've not thought about is what families hold dear and what you yourself hold dear, being your assets, your family links, your relationships, and the things that you want to remain within the family that have been adding value and will continue adding value to yourselves as as a unit, and also to the economic unit you provide in the country. How legacy looks like in Kenya presently is traditional. Yeah, we hold real estate, we hold cash and cash equivalents in individual names, in our personal names, whether it is through your patriarch or your matriarch, that being your parents, or through yourselves. If you're in a couple situation, maybe you hold your assets jointly, or you each hold your own assets individually. They're diversified. You have some apartments here, you have some land there, you have some commercial property, you hold a business, maybe it's legally registered, or you're just simply running your business on a day-to-day footing. You also hold your cash accounts, your investment accounts, whether that being the moderate type of investment, the moderate risk type of investments like government securities, or you're more desirous of the securities. All those are held in individual names, or for the more savvy or sophisticated person, they have registered a company or a business name. That is a traditional way that we are holding our legacy and our legacy property in Kenya.
I'm good, thank you, Winnie. I'll go to James now. James McLean is the director of Fusion Capital. James, we could probably refer to you as an off-taker. So perhaps you can comment on the current structure and the current way that assets are being held.
Yeah, sure. Hi, everyone. So it's true. I think we position ourselves as buying things that are hard to buy and selling things that are hard to sell. That's kind of where we fit in the market. And I think at the moment we benefit from the lack of planning in that of the 4 deals in our IC at the moment, 2 of them are coming out of estate planning, or estate planning that hasn't been done. So it's something we've looked at. We think that I think we're going to hopefully talk about the fact that Kenya does have the structures in place, but we never buy from those succession structures. We are always buying from, as you say, a family, and then 3 daughters who are living in the US and a son living in Canada. And that's where kind of we find a gap, is that kind of discourse.
Okay, thanks, James. So clearly it's not a fully functioning system. It's slightly broken, I would say. We'll go to Vera now. Vera joins us from Rogers Capital in Mauritius. Vera, how can these families and funds structure their legacy planning more efficiently?
Thanks, Ryan. It's a pleasure to be here today, especially coming all the way from Mauritius, so thank you. As Winnie mentioned, legacy is very often linked to financial preservation, but legacy is not just that. Legacy is more about, especially in East African countries, it's more to do with values, family vision, strategy, and culture. And I believe families can, well, in practice, they do structure efficiently if they consider a few things. So there are different ways that we can actually structure wealth and preserve assets and grow, accumulate wealth outside of Africa. The ways we can do that is we can set up trusts, we can make use of trusts outside of your home country, set up foundations as well, and also companies and family offices. Family offices can be multiple family offices or single family offices. Now, I am from Mauritius, so I will just touch base on why we think families can structure outside of their home jurisdiction into a country like Mauritius, if not anywhere else. Now, Mauritius is a tax-efficient jurisdiction. For example, a trust in Mauritius is a not registered trust. It's not a legal entity. It can be in different forms. It can be a settlement trust, it can be a purpose trust, or a discretionary trust, whereby the settler, being the actual family or the owner of the assets, have more or less, I wouldn't say control, but overview of the trust and the assets in Mauritius. The trust will be managed by corporate trustees who are licensed in Mauritius. The trust is tax resident in Mauritius, but it doesn't pay tax because it has a tax residency certificate. So depending on the type of income, the trust will be zero rated. It's not going to pay any taxes. Foundations are very similar to trusts. So that's a very good way of actually structuring offshore as well. It's not a trust and it's not a company. So it's in the middle. It's a legal entity. It's registered. It files an annual return. And the client, who is the actual owner of the assets or the wealth, especially being a high net worth individual, can always be involved with a foundation. So as the founder, he can be a council member as well. Foundations need council members and a council. So he is always in touch with his wealth, of how the assets are being managed, how the assets are being grown, if he's happy with the advisors or not. And lastly, I'd say companies are very popular as well to mirror what most families do in their home jurisdiction. So these kind of companies can be mirrored in Mauritius as well in the forms of trading companies, import-exports and all that, and family offices as well. I'd like to add family offices have a 10-year tax holiday in Mauritius. So that's a very, that's an incentive, especially for high net worth individual, to have a family office in Mauritius whereby they take advantage of the tax holidays and keep growing the wealth for next gen. Yeah, thanks.
Thanks, Vera. Just sticking with you for a while. What can go wrong? Obviously, there's some of those I think could be perceived as quite complicated structures. Maybe they're not. But what could go wrong, and what should families and funds specifically look out for?
Obviously, when families are structuring, there are many aspects and points that need to be considered. We need to make sure that the financial center the family is going in is a credible one. It's a regulated one. The families themselves are familiar with what that IFC, the International Family Financial Center, is all about. I believe education is key, and families, especially like existing owners, they need to make sure all the heirs are being educated in the sense that they know how to manage the family's vision, strategy, and values going forward. They need to have full sight of the actual picture without losing any values. So that's part of the succession planning. They need to have a good formal governance of the structure. So if it is a trust deed. The trust deed must be quite detailed with governance structures, framework mechanisms. Same for corporate structures, so the constitution, the family themselves need to have a constitution of how they want their assets, their values, the wealth, their legacy to be managed. And that needs to be communicated. Diversification of assets is another one. So I believe families need to start thinking about moving outside of their home country, going beyond local, regional, I'd say even outside of their home country. So geographically move, diversify their assets. That's very important. Liquidity and risk management is something else that needs to be considered and often not looked at properly. So, you know, in period of downturn, economic downturn, families need to make sure they have enough cash, enough liquidity to fall back on. A buffer is always good. So it's great having real estate, having investment portfolios as investments, but there must be a buffer of cash, which is quite easily available as well. And finally, I believe, and the session before that is very relevant actually, because we need to embrace digital transformation. That's for sure, we have to. It's hard for certain family members and high net worth individuals right now in this current day and age to accept transformation in terms of digital transformation and technology. And I believe that's very important. It's part of, it's moving with time. And it's good to have that sort of visibility in a, it will bridge the next gen gap as well. So it will make next gen more involved in family assets and management.
Thanks, Vera. Let's move more to, I guess, a banking approach. So we'll come to Anne now, who heads up the industrial and real estate for Stanbic Bank in Kenya. And thinking about the financial sector, what solutions are available to protect, sort of long-term protect the interests of families and funds?
Thanks very much, Ryan, and good afternoon, everyone. I think I like your trend of the questions. Now we've defined what's legacy, how it's owned, what's the transition in that space, and now we are talking finance. Real estate, as you know, it is capital intensive, and a lot of that capital still largely comes from the banking space. I like to look at the perspective of capital that of real estate that is a financial investment instrument. It's really a housing of wealth, and that's where the legacy element comes in, and wanting to build that wealth, to protect it, to have a return that's sustainable. So to the question you raised, I'll say that primarily it starts with the objective of the investor. Is this family or is a sponsor behind real estate for the longevity of the asset so that they have a physical asset they pass on to the future generations, or are they purely looking for a return? And it can be in liquid form, sometimes it comes liquid and goes back to real estate and so on. But largely the trend we see is that real estate players hardly quit entirely. Once you're in real estate, you're forever building that spec. So the common themes, notwithstanding the drive or the initiative of the person, the common theme is that you want to maximize your value, you want to maximize your returns, and what comes to challenge that is that sometimes when you have an asset that was built a couple of decades ago, it will be challenged from a returns perspective with the newer assets coming into the market. The tastefulness of that asset, it's transitions with the years. So some of the ways or trends we've seen, the sponsors of these legacy assets think is one, to grow your portfolio so that you can move away from single asset risk, concentration risk. You also want to diversify geographically. You want to diversify from an asset class perspective. And again, as I said, that's capital intensive. So that's where banking comes through to say, what can we do with your existing portfolio to create a liquidity event that enables you to grow that portfolio. Another aspect and a need for liquidity, the trends we see is that you want to maintain the value of your asset. Either you're facelifting it, sometimes based on its location and how the town has grown, you need to repurpose it. Sometimes you just need to, upgrade or give it some cap value, and so the infrastructure around it becomes very important. So from a banking perspective, we look at your wider portfolio, what is the need at hand, and how can we create a capital event using your existing portfolio. That said, I think from a Standard Bank perspective, we don't just lend. I guess we look at the whole spectrum, and advisory is a big part of it. How we advise developers, really, whether you're family owned or it's a legacy portfolio, it shouldn't preclude you from the benefits of how creating a sustainable real estate platform enables you to grow into the future, enables you to attract the right types of capital beyond the local pools and family pools of capital. Depending on how you're structured, then you can attract international private equity firms. You can, you can be ready for listing and so on. And that is a journey we like to work with the developers right from the start. How you organize whether your debt sits at the holdco or each asset is included in an SPV so that there's transferability of it and so on. So I think it transcends the generations, and what will be useful for these investors is to partner with skillful advisors, and we want to think of ourselves as we want to offer ourselves in that space. Let's walk the journey. Let's help you build a platform that is scalable and sellable. It can create liquidity on its own. It should have its own longevity. I'll pause there. Thanks.
Okay, thanks, Anne. I think it's an interesting point you raise about partnering with skillful advisors. There's definitely a segment of the market that goes alone, self-performs. I think that's actually consistent across the real estate industry. Be it on the advisory side or the use of construction professionals. There's definitely a sector that self-performs. Just, you touched on portfolio there. From your experience, and I'll ask you this first, but I'm happy for others to chip in as well. What asset classes are we seeing as sort of being interesting to family offices, private equity funds, other funds that you're working with? Are there particular asset classes that are hot right now, or are there ones that are perceived to be much more safe than others?
Thanks, Ryan, and happy to go first. I think real estate is driven by the growth in the economy, the new trends coming up, the new sectors growing require real estate as an infrastructure that goes with it to support that industry. So a lot has been said in previous panels. I was listening, and we're saying that, of course, we're saying the digital space is growing tremendously. We've seen, I'll put that in the commercial space, and of course, there's a lot of asset classes growing in that space. When I zoom away from what has already been said to say Kenya is still a regional hub, and we are attracting a lot of foreign direct investments. There are international companies looking to set their hub in Kenya, looking after East Africa and with an aspiration to grow into the wider Africa. So how you provide a quality asset from an office perspective, and if it's an industry, quality grade assets that they can utilize is something that's driving demand. And so green buildings and ESG qualities become very topical. In one of the forums, it has been said that it's either green or nothing, because the aspiration of having an asset of global standards, regardless of where you are in the country, is becoming big. And obviously, residential of all forms. We talk about affordable, but I think as the economies grow and we have second generation, the need for also mid-income kind of housing is important. I talked about diversification earlier, and another trend that is in the market and carrying on is mixed-use assets. People still want the convenience of, you can live, work, play within reasonable radius, and how we can bring that, we can solution for that through a single real estate asset is something that is taking up a lot. There are many others. I can talk about retail space. We're talking about neighborhood malls. SEZ is big in our country. It's been driven by our government, and we as a country, we are large on services, and BPOs are significant, and they continue to grow. So there are many. I've just touched on a few that perhaps had not been mentioned in the conference before. Thanks.
Okay, thanks, Anne. Does anyone else want to come in on that question about you know, the interest from these funds in certain asset classes? James?
Yeah, just a really small comment of something we tried to tap into. In Kenya especially, people really do understand owning real estate, and it's the first aspiration. It's what people aim to do. So one thing we found very interesting, and we positioned one of our assets for, was people wanting, you know, they don't want to own a piece of a REIT. That will come. That will come, that they'll see that a REIT professionally managed is the same exposure. But they might have, you know, 50 to 100 million shillings that they want to hold some kind of commercial asset. So we've actually found a lot of people buying office spaces for their own business, which they then hand immediately down the chain, or buying their friends' office business spaces. So one of the things we've tried to do is create a product for that. So someone who has 100 million, doesn't want to go buy a house in Runda where your yield is 5.5%, well, let's be honest, 3%. Actually, they've started to get savvy to this idea that I can buy 500 or 2,000 square foot of office space in this building, and I'm going to get 9.5% yield. So it's an interesting area we've been trying to push our product into.
Yeah, thank you, James. And I think, you know, we at the CBRE, we've worked on some, let's call them more aging real estate portfolios on behalf of our clients. And it's interesting to see the repurposing that's happening. You've got some really interesting urban regeneration schemes happening in Nairobi. You've got, as we were talking about ESG, and you've got companies, businesses that are, effectively trying to go green as much as they can with old structures. And there's ways to do that through efficiency of energy management, all those kinds of things, which is becoming more and more important because the tenants are demanding it. So it's keeping up with the times as being really important. Winnie, I'm going to come to you now. Obviously, we've sort of focused the panel a lot on structure. There's obviously a lot of pitfalls, and what I'm interested to know is, have structures, these holding structures of assets, has it changed in the last 5 years due to maybe changes in the regulatory environment or any other factors?
Yeah, thanks, Ryan. It's interesting how real estate is like the bedrock of investment, but if we're able to help Kenyans and Kenyan families learn, and even just East African families, because we have a lot of globetrotters in East Africa. Yeah, you have Kenyans living in Tanzania, and Tanzanians living in Uganda, and, you know, so on and so forth. The regulations over the last 5 years have kind of opened up families that have faced either a snag, frozen investment where you have been negotiating with a developer, or you've been going into joint ventures, but the person who has been instigating and driving that particular value add for the family either passes away, becomes incapacitated, is not able to continue with the deal, and the deal hangs. And a lot of the trending businesses tend to avoid conflict. I know for your business, you use the hard to buy as a selling point, but it's easy to buy when you have a structure. Once you've dealt with the conflict, and this is how the law has dealt with the conflict, make it easier for people to set up their own legal entities. So that may be a company, and family companies, give them an incentive to set up a family company. What does that look like? You own real estate as a family, maybe as a couple or as a parent and child. You're able to move that real estate very quickly into the family company without any tax, and or rather the hefty tax where we pay in terms of stamp duty being valued at the value of your asset. I know the proposed introduction in the current finance bill is to even include sole proprietorships, sole-owned companies in that bracket of having yourself, moving your property into your own company where you have 100% shareholding, then you become tax exempt for purposes of stamp duty. You have that incentive, and the law has kind of geared towards making people lose individual ownership because it falls apart when something happens to that particular individual. And we're mortal beings, and we face, nature and other afflictions. Two, we have trusts. Trusts have come into the conversation. The penetration of real estate investment trusts, much as we thought would move faster than it has, is still an avenue to think about. But we've also seen the frontage of family trusts, where you may not fully understand the nature of the real estate investment trust. Maybe you don't even trust what the trustee is doing, what the trustee could do, and you want that option of learning the trust for yourself, trying to nurture it and grow it into a thing that your family can manage, or you can pass on to your child. Or if your child decides they would like to relocate and become a global citizen in another country, you're still able to manage that particular asset that you've placed under something that will forge forward with your instructions, and your children will still benefit. Or if not your children, the people that you want to benefit will benefit without it being a point of assumption or hope. Yeah. So Kenyans are not very poised to right their wheels, and we fall to the pitfalls of succession, where something holds, you have a contract, it freezes when that person passes away, or it freezes when that person falls sick and is unable to continue. So the trust aspect allows that person to just create a structure that will take over from them. We call it a shadow of yourself, where you grow, you put your assets, be they real estate or cash equivalent assets, and then you yourself point out the people you would like to take over. And hopefully at that point you'll have understood the value of trust administration and accounting and other such like compliance measures, that you'll appreciate the value of a corporate trustee enough to hand over to them that structure that you've created and nurtured through the beginning of that entity. So the family-owned companies, family trusts, and also the discussion of just combining those two into entities that can hold one another and protect from indecision or decision paralysis, and actually help things move along from the person who's the vision bearer, who can lay it out, print it out in writing, make sure those instructions are upheld and transferred, handed over to a person who will literally execute because it is their professional or their personal obligation. Thanks.
Thanks, Winnie. We focused a lot on the the legacy side. So I think it's time to move to the exits, the liquidity side. Arguably the more difficult part of what we're discussing. And James, I'll come to you. Obviously at Fusion Capital, you've had some high profile exits in the East African market. To what extent do you believe that these successes are a resurgence of the capital markets? And do you have any advice for anyone here, either holding a portfolio of assets that they're looking to divest in this economic climate?
Yeah, thanks. We've had a good run, but it's worth saying that was after a drought, so it's not like we've been performing consistently. But we have exited 3 big projects in the last 2 years, one in Kenya, one Rwanda, and one Uganda. I don't think I could sit here in front of people who really understand the industry and say, yes, capital's flowing back to East Africa, because I don't believe that. To put them in perspective, every single one of those exits was a slog. It was a repositioning, or for one of them we had a golden purchaser. We grabbed hold of that golden purchaser and we led the deal and we pushed it through. But the other ones have still been, finding the gap in the market, like people who want to buy 100 million shillings worth of office, not 1 billion shillings worth of office, and trying to kind of give them product. So I don't think I can sit there and say, yes, we've the money's flowing back, and we get knocked on the door with people purchasing stuff. They are slugs. As I say, we see ourselves as people who sell things that are hard to sell. And I think But the other side of that is the local structures are starting to become more sophisticated. So our Uganda project, we just sold to a consortium of business people who'd come together and had a pool of capital to buy. They had dollars. The dollars were sat there, and we sold to them. So I think at the moment we should be realistic. The real money, the real people buying are locals, and getting the structures that work for them is kind of the only way to do it. That's in our opinion. Yeah, I think as far as advice, I think there are a lot of good professionals out there. Like, do use advisors. There are some good. We've had some real help from advisors in our exits and in our structuring, and I'd say with interest rates coming down, we're hoping there's going to be a bit more demand. But let's see how quickly interest rates come down. I'm looking at our banks that we're borrowing from at the moment and seeing the rates aren't quite coming down yet. But yeah, I'd say the advice is to be super flexible when you exit. And if you do find a golden purchaser, you find someone who wants what you've got and has the cash, drive the process. Don't leave it to the purchaser. Really take them through the process, make it a partnership. I'd say that's all. But like I say, it's not that we've hacked it. We had 3 years of pretty much selling nothing, and recently we've sold 3 and 1 more on the way. So yeah, it's been a turnaround, but I'd say from graft as opposed to from a flood of capital.
Okay, thanks, James. A bit like buses then, yeah?
Yeah, exactly.
Okay, Vera, I'm just gonna, is there any sort of, I guess, a parting shot, any final key point that you want to convey to the room?
I think the key takeaway I would like for this audience is for families, entrepreneurs, and high net worth individuals to venture more. Do not be scared to look at global opportunities, to see how you can actually structure outside of Africa, and it's tax efficient as well as asset protection. So I would like to just, I know it's a cultural value as well. I mean, but it's always good to see what else is out there in terms of asset protection and wealth accumulation, and how it can be done with the help of a robust support system who will be third parties, not quite involved in your structures. You will be still managing your structure, your assets, have full visibility of everything, but with the support of a robust advisory board, banking partners, investment advisors, and directors and trustees. So I think the key takeaway is to look outside of Africa and see what else can be done.
Thank you, Vera. Winnie?
Right. I think my parting shot would be open up from the rigidity of owning your own stuff. Kind of let it go and understand that ownership doesn't necessarily translate to control. Sometimes you can go out of control even if you own it. So you can lose the ownership into something that you're able to control and gives you a better way of structuring, so that even if you stay local or go global, you maintain that control in an easier and smoother transitionable structure.
Thank you. Anne?
I will add to what they have said and hone in on liquidity, both on the buying side and the exiting side. If you're buying, there's an opportunity for leveraged buyouts in real estate. A real estate asset can always carry some debt, so that you don't have to, equity is harder to raise and more expensive. So work with your financial partner so that we can enable that purchase. And then on the exit side, again, I'll reiterate, it's about how creating a platform that can attract liquidity without dismantling the whole family or the family objective primarily, where you can sell one asset and retain a portfolio. You can list one part of the business and retain the rest. It gives you access to multiple aspects of raising liquidity, either through listing, we said, you can create a REIT around it, And I guess it all goes down to the structure, and it goes hand in hand with the lending.
Okay, thank you. It seems we're out of time. James, I think we caught your parting shot earlier. But thanks, just want to remains to thank the panel very much for your time today. Thank all of you for attending, and we will now pass back. Thank you.